It's time to discuss why I will never hold those good-for-nothing bonds. Relax, I'm just playing. Kind of. I've been asked many times on the channel about why I don't hold bonds in my portfolio. In this video, we'll take a deep dive to explore why I will likely never include bonds. And a bonus topic for those of you that are in retirement or close to it is that bonds are even worse for your needs. You're either nodding in agreement at this point, or you're really mad at me for my ignorance on the topic. Either way, I highly implore you to watch this one until the end. It isn't a hype video, and I'll provide plenty of sound reasoning. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please slam dunk that like button, subscribe if you haven't already, and drop me a comment below on your thoughts about where and if bonds belong in a well-balanced portfolio. We had 8 new channel members this week. A huge shout out to the 8 of you that are on the screen now, and of course, as always, everyone that's been here all along. I really appreciate the support, you guys. I hope you're enjoying the emotes, the badges, the comment priority, and the nerdy spreadsheets. I'm loving the back and forth with this community, and I really do appreciate each and every one of you. Let's grow. Bond basics. We'll start by exploring the differences between stocks and bonds. When you buy a stock, you're buying a portion of the company. This means that you are an owner, and you are officially tied to the company's performance. Bonds, on the other hand, allow you to loan the company or the government money. They pay you a fixed interest rate over a predetermined amount of time. There is no equity involved with bonds. You don't own a certain amount of shares or anything like that. Bonds are not entirely risk-free because the companies that owe you money can go bankrupt. But assuming that you're buying quality bonds with high credit ratings, you know exactly what you're signing up for. Bonds have a duration of anywhere from a few days to 30 years. And the interest rate, known as the yield, just like dividend stocks, will vary based on the type and duration of the bond. You take on more risk when you buy shares of a company, when you buy shares of stocks, compared to buying bonds. And we're going to dive into the details of the returns in the next section. Stocks versus bonds. Stocks objectively provide better long-term returns. For example, if you invested $100 into the S&P 500 in 1928, fast forward to 2021, and you're sitting on over $700,000. Now, if you took that same $100 and invested it in 10-year treasuries over the same duration of time, you'd be sitting at just over $8,500. And there you have it. I am guaranteed to have more money by investing in the stock market compared to bonds by the time I'm 142 years old. Wait a minute, I think I'm missing something. In all seriousness though, any informed investor would agree that someone with 20 to 50 years remaining to put money into the market will be better off with stocks. Especially with the low-cost ETFs and index funds that we have available to us today. Thank you, Jack Bogle. Back in the good old days, bonds helped save us from ourselves. We have always been terrible individual stock pickers. That is as true today as it was back then. We now have an easy button that we can't screw up with our index funds. This makes investing in stocks, aka ETFs, way more viable for everyday investors. But there are times when bonds outperform stocks. Stocks are not always the king. Let's jump over to an article to see when bonds shine. This is the article, and it's titled Historical Returns for Stocks, Bonds, and Cash. And before we dive into the highlights, I want to point something out that's very important. And it says it right here in the first sentence. The last 3 years have been some of the worst in bond history, including, quite literally, the worst year in bond history, which was 2022. So, and that says that here, 21 was down, 22 was the worst ever, and 23 is better, but still bad. And then it talks about how during that duration, the S&P 500 was up about 10% per year, and that's even with the rough 2022. Now we're getting to what I promised. From 2000 to 2011, a big stretch of time, the S&P 500 was up 0.5% per year, which means that after inflation, you would have lost money. Cash is cash. It's always roughly what it is. But it was the 10-year treasuries that provided the best return at 7.2% per year. So in 12 years, bonds dominated 7% versus 0.5% of stocks. In another 10-year period from 1969, very nice, to 1978, the S&P 500 was up 3.2%. Again, was negative if you add inflation. Bonds ended up returning 4.8% during that time. So you won by 1.6% over a 10-year stretch. Okay, and then the author goes on to say he is cherry picking time frames that make the bonds look better. If you really look at the long term, stocks are obviously the best bet. And you have this graph here, stocks are more volatile, higher ceiling, lower floor, and then bonds somewhere in the middle, and then cash, of course, scrunches it down the most. But if you zoom out about 100 years, stocks are up, and I hate when it takes inflation out personally. I wish this was the full numbers, but stocks, net of inflation, are up 6.8%, bonds are up 1.6%, and cash is basically flat. Now, if you plug a 5.2% difference into any portfolio projector, you will see that this is deep six figures, and most likely 7 figures for a long-term investor over a career. So stocks, again, are a no-brainer over the long run. But in the short run, anything can happen. And it's nice to have some stability in the portfolio. We're going to get there. Remember, even those cherry-picked time frames only had bonds outperforming stocks for people that were not dollar cost averaging in. Stocks will make you massively richer when you're piling money in during the big crashes. These rare wins over long stretches of time strictly apply to those not adding additional dollars to the portfolio, typically retired folks. But not so fast. Retirees are hurt even more by bonds long term. Let's find out why. SCHD pays and protects. SCHD is a conservative dividend ETF that has not fared well in the last few years versus the big growth ETFs. It's only 9% technology, and it misses out when the market's firing on all cylinders like it has been lately. But the methodology does focus in on companies that pay and grow their dividends, have good free cash flow, and relatively low debt. This has it pulling in a lot more value compared to growth relative to its dividend growing peers such as DGRO, VIG, or a dividend payer such as VYM. The combination of a solid starting yield and the dividend growth rate will blast you past the bondholders over the years. It also has an incredibly stable floor because of the value-based factors it uses in its screening and scoring process. SCHD is superior to bonds for portfolio stability and long-term cash flow. It's a great bond replacement for people with long-term outlooks. And I can just feel the bogleheads raging right now. Relax. I have read pretty much everything that's out there. I understand that SCHD is not literally a bond. Stop huffing and puffing and secure that pocket protector. You're going to be okay. Now let's dive deeper. Key metrics with the backtest. I think we can all reasonably agree that investing in low-cost, passively managed ETFs or index funds is king for active investors growing their portfolio. We'll focus on retirees or people that are close to retiring in this scenario. This is usually the point when people think that bonds make the most sense to protect their portfolio value. Let's say that the retiree we're about to look at has saved $500,000 across all of their accounts during their career. We'll see how the $500,000 would have played out if it was put in the following. The first portfolio will be 100% bonds, and we'll use the popular ETF BND, which grabs over 17,000 bonds. And then we'll use the ETF SCHD, the one I'm advocating for. We'll throw in the S&P 500 by using VOO, and then we'll throw in a growth ETF as well, and we'll use QQQ. Before we dive in, let's clear up a few things. We do not expect bonds and SCHD to outperform the market, especially in the last 10 years that I'm able to pull up because it's been a bull run. This is never the purpose of bonds. I'm highly aware of that, but we're going to take a look at other key factors once we dive in. The whole point of holding bonds, or in my case SCHD, is to stabilize things when the QQQs and the VGTs and the VOOs of the world are collapsing. let's go. All right, we're out on Portfolio Visualizer, my favorite website to run portfolio backtests. Unfortunately, I was not accepted to the affiliate program yet, but I want to show you guys the best data possible, so I just coughed up to $360 so I can run more than 10-year backtests. And as you can see here in this one, we're 1/1/2012 through year to date. I've scrolled down to the performance summary. So we have the 500,000 in each holding. Dividends are not being reinvested. I repeat, no reinvestments. We are living on the money. So you can see the imbalance is just what the price has done. And with bond, it's 430,000 you end with over those 12 years and change. With SCHD, you'd be at 1.5 million without reinvesting. QQQ, 4.2 million. That's ridiculous without reinvesting. And of course, this is just for context. We're not comparing bond to QQQ. And the market I put in VU is 2.1 million. So where we want to look is at our best year. Okay, that's cool. You know, our bonds have gone up 9%. SCHD had a 33%er. And QQQ and the market have gone bonkers, right? But the worst year is extremely important. We have over 12 years of data. The worst year for bonds was 13%, and that was last year. SCHD's worst year in its existence is negative 5.5% in a single year. And then QQQ, you can see, drops hard. That's probably 2022, I'm guessing. And the market, I'm guessing that's 22 as well. We'll get more into that. Max drawdown, very similar with these two, not with these guys. And then we're not going to worry too much about these ratios because they're so different. That's risk adjusted stuff. Okay, now these annual returns are important because this is going to show our ceilings and our floors. We have BND as the blue one, SCHD is the green one, and QQQ is this gray one. And this teal one, yes, I understand. Thank you for the comments last time, is VU. So what we're comparing really is bond and SCHD, because my whole point to all this is to show that QQQ and the market, if you put everything in them, they can go down 32% in a year. And it's been worse in the past too. This is just the worst year in the past 12 years. It could be even worse, right? But look at that bad year. Look at SCHD at -3 and BND, and let's not be too hard on it. It's its worst year ever at -13. As soon as the Fed funds rates drop, you're going to see a reversion to the mean, and it's going to have a few more of these years and maybe even a little higher. So I wouldn't worry too much about it. Still retains your value pretty good. But my point is, look at SCHD. On its worst years, look at it. I'm not saying you have 1.5 million compared to 400K, it's a no-brainer. I'm saying, and we'll get to the real point that'll make your jaw drop, because this isn't the point yet, but the floor is incredible with the value-based methodology that SCHD uses for free cash flow, low debt, and dividend payers and growers. So you get a PE ratio that's much lower than the market, and you're on the value side. But usually in those big crashes, generally speaking, your growths, your VGTs and your QQQs are gonna fall face first. And this is where you stabilize with value, and that's what makes it so good over the years, and bond. You can see SCHD and bond definitely have the lowest ceiling, but the highest floors. They're comparable as far as their floors. So trailing returns, again, not the point, but important. You know, and bonds have had a rough decade, so this would be a little different if you zoomed out, but I guarantee you, I'd put a couple of my kids on the fact that SCHD and the market in QQQ, if we zoom out 20, 30, 50, 100 years, will beat bond. It's just more volatile. Well, these ones are, but as you saw, SCHD is sort of that little cheat code. But when you look over the last, we won't go through all these like we usually do. Over the full duration, 12 years and change, SCHD is an annualized 12.6% return, and that's with it doing terribly compared to the other ETFs and compared to its peers. VIG, DGRO, everything's ran laps around SCHD, and that's why everyone's all hot and bothered. But I'm talking floors here, not ceilings, and even with everything, 12.6% compared to bonds giving you a wonderful 1.4%. That's not all because of the last couple years, trust me. But now, take a look at the graph, and then pick your jaw off the floor and let me get started. The first year, SCHD has a slightly higher yield than bond back in 2012, right? Remember, we are not reinvesting dividends. That is not helping any of these funds. Look at the 15.4K compared to 11.6K. This is important. We're retired and we're living on the money. We need that stable portfolio value, but we also, holy balls. What is, wait, So Jeff wasn't lying in his videos? That retire on SCHD that says you double your dividends every 7 years historically without buying additional share? I thought he was full of crap. Oh my God, he wasn't lying. Now we're making $51,000 in 2023, $51,000 per year, no reinvestments, compared to 13.5. And this, my friends, is what will be here. Even when the market's bad, SCHD has proven that it always increases its dividends. I would rather have 1.5 million, nice little bonus. We've made 1.1 million over bond and and $51,000 per year that's never gone down and will forever grow versus a very erratic based on the federal funds rates and many other factors, 13.5K. Wah, wah, wah. I do not hold SCHD to beat the market, and I don't hold it to outgrow DGRO or VIG either. I hold it as a true counterbalance to my other holdings of VU, VGT, and QQQM. It's the best portfolio stabilizer I've been able to find, and it's superior to bonds in everything that matters to me. I'm not saying that everyone should take this approach, but at least I have a video now to link when people are harassing me about the lack of bond exposure in my portfolio. The real secret to all this is to invest as much as you can as soon as you can. Regardless of your thoughts about things like bonds, if you set up a solid system and stay the course, you will win this simple game long term. A huge shout out to this being my 69th video. Nice. Check out one of these 2 videos if you'd like to learn more. Thanks for sticking around till the very end. You earned a cookie. Thanks for watching, and I'll catch you in the next one. Peace.